Welcome back to the International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, the home buyer coach, here on KCAA Broadcasting Network 1050 AM and 106.5 FM. Welcome to the second segment. We are going to continue with taxes in a sense, but we're going to cover impound account and how an impound account works. A common confusion in establishing an impound account when you get a new loan is understanding why you have paid for the bill or a tax or insurance and also are collecting a payment in your monthly payment. So to explain how that works, let's try to give a visual. So what happens is that you are going to pay, let's say, your insurance premium upfront for 1 year. So it is paid from today, March, through March of the following year. So it's purchased in March 2023, and it is due again in March 2024. So you have paid that in full. In your monthly payment, you're also going to pay 1/12 of that bill amount. It's going to be divided into 12 payments, and it's going to be included in your mortgage payment. If you think about it, you've paid for the whole year and it's due in 12 months more. So you start paying now, month 1, month 2, 3, 4, 10, 11, 12. At the end of 12 months, you have another year worth of your insurance bill. So when that bill comes due, the money that you've put into your impound account pays for the next renewal. That renewal now will be good to 2025. Your next mortgage payment goes into your impound account. The 1/12 of your hazard insurance bill goes into your impound account, and you pay it again for 12 months. At the end of 12 months, you have a full year to pay your renewal. So that is how that impound account works. The same thing for your taxes. You're paying 1/12 of the annual bill as part of your monthly mortgage payment, and it is accumulating so that at the end of 1 year, there's a full year available to pay the renewal. Now, couple things. The renewal isn't always the exact same amount. Most of the time, your taxes go up a little bit, and most of the time, your insurance goes up a little bit. So even though you've been paying 1/12 of the value of the current bill, the next bill, let's say, could be $100 more. So you're $100 short of a full renewal premium. So you're going to have to increase your monthly payment, your monthly 1/12 of your hazard insurance bill based on the new bill. But you also have to pay the new bill in the current year. So let's say you're $100 short. What will happen is your lender will pay your insurance renewal at the new amount. And then at the end of every year, usually in November, they are going to do an analysis of your impound account based on the bills they received that year. And they are going to say whether you have too much or too little in your impound account to cover the future bills. And then based on an aggregate, so based on January through December, the deposits that you make into your impound account and the bills that will be due and paid from your impound account. And they're going to make sure that that impound account only goes below the amount or at least has a certain amount in the account at all times. So what this is similar to is your checking account. In these days with online banking, most people don't balance a checking account anymore. But in the old days, we didn't have online statements and we had to say, this is my balance. These are the bills that have not cleared. We have to subtract that from the balance, and we have to make sure that we have enough to cover all the things that have not yet cleared the account. So it's the same with an aggregate analysis of your impound account. They're going to look at each deposit, each withdrawal, and make sure that that bottom line balances where that there's enough to cover the bills for the year. Now, considering that the taxes, as we covered in the previous segment, actually are paid each installment in a different year, then when they do an analysis, they're going to have the new bill, But at the end of that year, they do another analysis on a new bill for a new tax year. So you can often have adjustments to that account. Now, where it is important to explain also is that I often get calls that my clients will say, I have a fixed rate mortgage, but my payment changed. So it's important to know that the components of your monthly mortgage payment, your loan payment is not changing. That portion of your loan payment is principal and interest. The principal interest on your loan on a 30-year fixed will have 364 payments of exactly the same amount and potentially one final payment that could be slightly different. But your total amount you pay each month also includes 1/12 of your insurance, 1/12 of your taxes, and if you have mortgage insurance, that would be also included. Those items will change each year based on any fluctuation or change to your insurance policy or your tax bill or the current mortgage insurance that's due. So those things will change all the time. Think about it this way, even if you didn't have a loan, you would be paying taxes for sure. You probably would have good coverage on your insurance to protect your asset. So you would pay those regardless if you had a loan or not. So if you don't have an impound account, you might have your house paid off already. So you're going to be responsible for paying your taxes and your insurance. 2 installments of your taxes, one renewal of your insurance is most typical. And that bill is going to change each year and you need to be prepared. One year your tax bill might be $3,000, the next year it might be $3,200. So you're going to have to make sure you have the money to cover your taxes and your insurance each year. But if you have an impound account, we're going to collect that money from you, divide it into 12 payments for each bill that's due, and we're going to adjust it every year based on analyzing that account. If you notice on your mortgage statement, you're going to have a balance of your escrow/impound account. Those terms are used interchangeably. It's an your escrows or your impound account, which is the savings account that the additional payment, in addition to your mortgage payment, in addition to your principal and interest payment on the loan, that additional money will be set aside into a trust account called an impound account or an escrow account. And that account is where your bills are paid from. It's a savings account for you to pay those bills. Now, we mentioned before this supplemental tax bill in the previous segment. So if you receive a supplemental tax bill, that actually has not been taken into consideration straightforwardly in your impound account. Now, when your loan officer, if they did a good job, they would know a better estimate or maybe exactly the taxes that are due on the property that you're purchasing. And they'll have an idea that the sales price will be similar to the assessed value. So most of the time, your lender has collected that higher amount of taxes that is going to be reflective of your new assessed value in the future. However, when an analysis is done to your impound account, if they have not received the new bill yet, then they will do the analysis and they have to return any excess in the account. So when they say balance, it's either high or low, short or overage. They cannot have any more money than necessary in the account, and they cannot have a shortage. So they have to return excess money to you, particularly when it's over a certain amount. Sometimes they can keep a small amount if you authorize it to stay in there, but generally speaking, they can only keep almost an exact amount of overage or balance in your impound account. So they're going to have to return any money. So oftentimes what happens is that by the time they do the assessment, there is a surplus. They send it back to you. Then the supplemental bill came. Now you don't have enough money in your impound account to pay it. So then it's going to create a shortage in your account if you ask your lender to pay it. And if they do pay it, it'll create a shortage. Then they're going to do the analysis of your impound account, and they're going to spread that shortage over 12 months. So not only are you going to have the increase to the monthly payment for the projected amount due, but you're going to have to make up the shortage in the account by them dividing that over 6 to 12 months to cover it. So you always can know, each year, like where that money is going by looking at your statements and seeing when bills get paid, and also reviewing your tax bill and your renewals when they come to you. So you can be kind of prepared for that. But the adjustment to your payment is just to cover those bills. If you have a fixed rate mortgage, your principal and interest is fixed, but your taxes and insurance can change, which will affect your monthly payment. So that's about how an impound account works. And basically, you can submit your supplemental tax to your lender if you have an impound account, requesting that they pay it, but they don't have to pay it because there might not be enough in the account to do so. And not all lenders allow you to do that shortage. So you do need to check with them and see if they'll pay it for you. And if not, it is your responsibility to pay. So in the next segment, we are going to go over how adjustable rate mortgages work. So I look forward to seeing you then. I hope you join us again for segment 3.